traders, welcome to Vant Trading for another educational video. My name is Mike Gabor and I'm a fund manager for a hedge fund that is focused on trading the markets. I have been trading for over 20 years and during that time I have seen many different types of markets. I've traded the 1999-2000 dot-com bubble, the long-term care crisis. I traded the 2007-2008 financial crisis and the volatility crisis that happened about a couple years ago where everybody was shorting volatility. And during that time, I have had lots of successes, but I've also had a lot of failures as well. And I remember what it was like to be a new trader and really trying to figure out how to navigate and be successful at this game of trading. So what I wanted to do today was create a video for you to explain one of my best trades according to my trade matrix that I do, and that's trading the SPY. Now let's take a look at what is the SPY. The SPY is an ETF that mimics the S&P 500 index. The S&P 500 index is a weighted average of a basket of stocks. Weighted being the key word because you have a lot of the largest companies in SPY that control about 21.8% of the index. That's important to understand as we look at some of the indicators that we use when we're trading SPY. The reason I use SPY, it's one of the highest volume trading vehicles out there. Now, let's take a look at some of the indicators that I use to trade SPY. There's two, the ADD and the tick. Now, the ADD measures the net NYSE stocks that are advancing versus declining. This is an important indicator for me because what it does is it gives us the understanding of market breadth. How deep is it? Do we have just a few stocks that are leading us? And it really helps when you see some divergences in the ADD versus the market indices. Now, the extreme valuations that we look at in the ADD is plus 1,800 to plus 2,000 net advancing, minus 1,800 to minus 2,000 net declining. And, again, looking for those divergences or maybe seeing stocks that are way constant in an extreme valuation could indicate a trend day. The other measure that we use is the tick. The tick is very important too because it measures the net last up or down tick of all NYSE stocks. Now, this is more of a short-term buy pressure or sell pressure, what's going on right now with individual stocks. And it's good at, again, providing us with some divergences or indicating possible trend day. So extreme valuations that we use in the tick is plus 500 to plus 800, minus 500 to minus 800. So you want to have both of these on your charts or near your charts when you're trading SPY. Now, talking about charts, let's go talk about levels, moving averages that we use to trade SPY. One of the most important moving averages that we use is VWAP. VWAP is the volume weighted average price. And, what's great about the VWAP is that this is probably something that's most important because you have a lot of professionals that are using the VWAP to really judge their market performance. So what happens is you have a huge hedge fund that wants to establish or accumulate a large position. Well, that fund to come in and buy a large block of shares at once could actually have an effect on price and can have an effect on the type of, cost basis that they get going into a position. And so what will happen is they will go to a bank or to a prime broker and they will place that order, and it's up to that bank or prime broker or trading desk to actually execute that order throughout the day to get the hedge fund the best price. And VWAP is what's used to really judge whether that was a good price or not a good price. Now, you got to be careful with VWAP because it's become a lot more in vogue for some retail traders, but it's still a really important average to have on your charts. It should be on every chart that you trade. I also have the 22 EMA on my chart, no matter what chart I'm looking at, because it gives a good gauge for, short term where we are with the particular security that I'm trading. And then you also need to have pre-market levels on there. So we like to have the high and the low and then the point of control. Why is pre-market levels good? Well, pre-market levels are important because it is the first really evidence that you get from the market on how buyers and sellers view this stock, right? But you got to be careful because the information that you're getting from the pre-market is really kind of skewed because you don't have as many shares or you don't have the liquidity and volume that you typically have during market hours. But it still gives a really good understanding of where buyers and sellers kind of feel where they are with this stock. So not knowing where the high and low of the pre-market level is really putting yourself at a disadvantage. Now, the point of control is where it's really that equilibrium point on the chart, okay? And it's the place where either the buyers, if it's higher than the point of control, then the buyers are in control of that stock. If it's lower than the point of control, then the sellers are considered in control of that stock. So really, understanding point of control is something that you want to look up. You want to make sure you understand. And then I also like to have the prior day levels on the chart, such as the high and low of the prior day, and then also the closing price. A lot of times you hear of a red to green move or a green to red move. Well, you don't know what type of move that is unless you can visually see it on a level on your chart. And then also what you want to have on your chart is the opening price of what the stock opened at for the day. Because it's important to understand that because a lot of times you'll have a huge gap up day. And especially important on gap up days because you could have a huge gap up day. How do you know if that gap up is a gap to fade? How do you know if that gap is going to be a strong trend day? Well, one of the most important indicators or one of the important price levels to understand that is really the opening price, because if you have a stock that gaps up and it shoots up, it opens up and it shoots up, well, if it keeps on going and it typically what will happen, it'll pull back down and it'll pull back down to the opening price and then it'll go back up if it's a trend day. Okay, if it's not a trend day, it'll go up and then possibly fade right through that opening price and then come back up and then keep on fading. That shows you that could be a gap to fade. It doesn't always work that way, but it's an important level to understand. And then finally, you want to have your daily chart levels, your support and resistance levels. You got to understand, where were prior gaps prior to through the months that, you've been traded in the security. What's the inflection levels? And this is really, where we, use our experience and we look at market profile, we look at market levels. And, I always say price, volume, and market depth and story is really what is everything you need to understand a trade, right? Well, price and volume are important. Okay, and so understanding, looking at market profile, where is the levels in this stock where you have the most buyers? Okay, where are they? Where's the weak resistance levels? Where's the stronger resistance levels? And where same thing with the support levels. So that's something important to understand. Now, the trading vehicle that we use to trade SPY is the SPY options. Now, if you're bigger or if you're buying a lot of size in options, you may want to look at the SPX. But, for this discussion, really, we're talking about trading using the SPY options. And I still today use the SPY options. SPY options, the key with SPY options is you want to buy those options that are close to in the money and near-term expiration. Now, I'm going to get into options and what they are, but it's important to understand you want to buy options that are close in the money and also near-term expiration. The advantages of using options are liquidity. It's very liquid, especially the SPY. Now, options aren't always liquid, so it depends on the vehicle that you're trading. But with SPY, there's a lot of traders in SPY. So you have a lot of liquidity at many different options as far as strike levels. And then also options obviously give you leverage. Okay, one contract controls 100 shares of a particular security, so it gives you a lot more leverage. And then also you typically see smaller spreads, and you have defined risks. So that's important. That's why we like to use the options, the SPY options, rather than trading the SPY. It does not make sense trading the SPY if you're going to try to scalp or be in and out. Now, if you're going to go over a longer term trade, little different story, and we can talk about that in another video. So let's talk about options. Okay, what are options? An option is nothing more than a contract that locks in a buy price if you have a call contract, or it locks in a sell price if you have a put contract for a set period of time. Okay, and like I said, every option contract controls 100 shares of the underlying security, and there's two parties to every contract. You have a buyer and you have a seller. Okay, the buyer gets a right to do something, okay, either buy or sell, and pays a premium because they have a benefit, they have a right, okay, but their loss is only set to that premium. Now the seller, which is the other person on the other end of that contract, has an obligation to do something, right, at a fixed price, and they, for taking on an obligation, they receive that premium, and they have unlimited loss. Now, let me explain options a little bit more. See, if you were to go buy 100 shares of SPY, the ETF SPY, okay, at $300 a share, right? That's about what? How much is that? $30,000, okay? That's a lot to buy into into a security, right? But what you could do is you can actually go, instead of buying the SPY, you could actually buy an options contract on the SPY. Now, if you buy an options contract, and let's say you think this stock is going to go up, okay? So ordinarily you would buy low, buy the SPY shares, and then sell the shares when it goes high. Well, instead of buying the shares, you could buy an options contract, and since you want the price to go up, you think the price is going to go up, you want to lock in a low price, right? And so you would buy a call contract. And a call contract would just be nothing more than a contract between me and you, okay? You are the buyer, I'm the seller, okay? And let's say SPY right now is trading at, let's say it's trading at 300, and you think it's going to go to 310, okay? So you basically come to me and say, Mike, you know what? I want to buy a call contract that gives me the right to buy 100 shares of the SPY at 300. I say, great. And you tell me, you know what? I want a month to be able to, have that right. Well, me being the seller, since I'm going to have an obligation to sell you those 100 shares at that fixed price of 300, I want to receive some value. So I'm going to receive a premium that I'm going to charge you. Now that premium, right, is, might be $2 a share I might charge you. Well, that $2, remember every contract controls 100, so it's in hundreds. So that $2 is actually going to cost you $200 for that contract. Now, if you pay me $200, have you bought the SPY? No, you don't own the SPY at all. What you have done is we have entered into a contract that locks in a buy price. Now, since we have entered into a legal binding contract, as the SPY goes up, guess what's going to happen to the value of that contract in the secondary market? It's going to go up. So as SPY, let's say SPY goes to 305. Well, at 300, you paid me $2 a share, right? Okay, well, $2, now it's at 305. That contract's $5 a share in the money. So what's going to happen is that contract's going to be at least worth now $5. And it's probably going to be worth a little bit more, and I'll explain why as we get into this. So as you can see, if you enter in this contract, yeah, you can actually hold it to expiration, or if it's American options, you can which SPY is, you can actually demand the shares today. Right? But the key is most people, 90% of people don't do that, because as the value of the contract goes up, you can just sell that contract for a profit in the secondary market. So let's take a look a little bit more at option characteristics. Why might that, remember I talked about that premium. If SPY went up to 305 and you paid $2 at 300, right? Well, the premium may be a little bit more. Right? Because here's what the premium is made up of. It's made up of intrinsic value. And intrinsic value is the actual value of the contract, meaning the intrinsic value of what the stated price is versus what the price in the marketplace is. And if SPY is at 305 and you have a right to buy at 300, you have a $5 intrinsic value per share. Okay. Now, let's say that happened the next day. Well, then you would have 29 days left, right, to still have that SPY possibly go up more. So there's a time value placed into the premium, because let's say instead of 29 days left, there's only 1 day left. right? Well, the chance of the SPY going up further in one day is not as much as you have in 29 days. So time is worth something. So part of the premium is part of time value. And then we have something called implied volatility. And implied volatility is really just, look at the markets now. Okay, the markets are really extremely volatile. We have the VIX heavily elevated, and so what happens is there's certain periods of time where you get wild price swings. So the person that's on the other side, the seller, wants to get compensated during those periods of time because there's a greater chance that your stock may swing in your direction a lot quicker, devaluing really the time value that was placed on there. So in periods of huge, elevated volatility, implied volatility is very high. And the way we really measure the options are gauged off implied volatility is based off the VIX. And so if you have a high VIX, right, and I think the VIX right now is just, crossed over 40 again, that is very elevated, right? Over 20 is considered very elevated. It usually doesn't stay high very long. A high VIX obviously favors the sellers because the premium they're going to get is higher. Lower VIX favors the buyers. And let me explain real quick why that is. Because volatility, if you look at the VIX chart, typically doesn't stay there for long. So if you're buying options that you're going to hold for a longer period of time, well, there's a chance you're going to be buying them really high because you have high implied volatility. And then your stock could even move in your favor, but you may find that the volatility is slowed down and that your price to your premium has actually gone down even though you're in the money. And the reason is because the volatility portion of that premium has gone away. So that's why it's very risky to buy options long term when you have, higher volatility. But here what we're talking about buying not holding past the day. We're talking about scalping. We're talking about day trades. So really, and they have something called the Greeks that define your premium, your volatility risk, and what options you get in. And you don't have to worry about any of that stuff. And you don't have to worry about any of this stuff as long as you understand the basics in options. I just wanted to go over that stuff with you because in case you try to do options into other different types of securities. But the key is for us, because we are buying and selling and not holding overnight, we're scalping in and out. We don't have to really worry too much about, intrinsic value, implied volatility, Greeks, and all that stuff. So don't worry about that stuff. But we're going to do an options class. I'm very big into options. I'm going to do an options class coming up over the next week. And with options, I will talk about, get a little bit more in detail on what you should be doing with options. Now, what I want to do is I want to switch to my charts. Okay, and I want to bring up some trades. I've picked out 3 trades over the last week that we had that were really good trades for you to look at. These are actual trades that you could have took, and I want to go over those trades with you now. Okay, so let me pull those up for you. Okay, let's take a look at some charts here. What I've set up for you is the 1-minute SPY, the 15-minute SPY, the ADD line, and the tick. Okay, and if you look at this chart, this trade was actually last Wednesday. It was June 3rd, 2020, and this wound up being a really great trade. So let me set this trade up, and then we'll go to the actual numbers of the trade. First off, if you look here pre-market, you can see that the SPY really, crossed above VWAP very nicely and started trending up. So let me show you some of the things on this stock. First off, this pink line here on these charts, this is VWAP, okay? That's the volume weighted average price. This blue line in here, if you can see this is the pre-market high. Okay, so that was what I was looking for as far as in this trade, a break of the pre-market high. Now, this gold level right here was a very important inflection point, very important level on the daily chart. And so that was really our what we call our target line. And this line, this blue line right here, is the 22 EMA. So let's take a look at this. Take a look at this chart. See if you can look at this chart and see if you can really see the trade. Now, we got some errors in there, so it's kind of not fair. But the biggest thing with this trade setup here, okay, is the stock was gapping up. Okay, so again, we were wondering what was going to happen with this gap up, and it was gapping up with the ADD in the value in the extreme zone. Okay, so it was above in the 1800, this gray area right in here, so you can kind of see where the ADD was, and the tick was in the extreme level as well, the 600 to 800 level right in there. So you can see the tick, was in that level for a good extended period of time. And if you look here, the white line, that is the 0 level for the tick. So on a visual, I'm a very visual person, and especially when I trade, I don't have time because the market moves quick. So I don't have time to sit there and look things up and look at different screens and stuff like that. So being a visual person, this is important for me. So seeing the tick really hover in the extreme level for such a period of time, and really staying above this 0 point line tells you what? It pretty much tells you that this is going to be a trend day for us, a trend extreme day. And so we have the ADD that was, cooperating, and we had the tick that was cooperating. So that was our two pluses. And so if you also look over here on this 1 minute chart. So by the way, if you're day trading, back in 1999, 2000, when scalping was really in, I was a really big scalper. The 1 minute chart, that's what we lived and breathed off, right? Because you had a lot of shares and you couldn't afford any wicks. But nowadays, trading off the 1 minute chart to me is just way noisy, especially if you're a novice trader. You should always have the 15 minute and the 5 minute chart up for any stock that you're day trading. It is so important, and it's so important to have multiple time frames, to trade with multiple time frames. I can't stress how important that is to be successful in trading. Now, if you notice, getting back to the charts, I have volume down here. I don't have any RSI. I have no MACD. I don't need any of that stuff, right? I'm pretty much just, price, volume, my levels. That's all I need to know. So let me take you now, back to how this, set this trade up and see the numbers of the trade. Okay, so here's the numbers on this trade, number one, that I just showed for you, the charts. Okay, trade setup, ADD was elevated, extreme range. Talked about that, saw that on the chart. Tick was elevated in extreme range, saw that on the chart. SPY was above and holding VWAP, and the 22 EMA was stacked pretty nicely. And we had a break of the pre-market high is what we were looking for. So our trade entry here, we got long at 9:57 a.m., a break of the pre-market high. Okay, and again, we were using the options, and you had a kind of an ascending triangle form, and we had a confirmation on this trade at 10:03 a.m. On a break of that ascending triangle. Matter of fact, a lot of times what we'll do when we see this type of setup, we will actually load up and buy more shares because it gives just even more of a confirmation. We didn't do that in this trade. Our stop loss typically in this type of trade is VWAP. Okay, we may give a couple ticks below VWAP because sometimes the stock will come down, break through VWAP, and then they'll drive them right back up. And again, that's something that's important to understand as a new trader. See, a lot of retail people are using VWAP, so a lot of times what they will do, the market will drive that price down below VWAP, knowing that that's where a lot of stops are. And so we'll always now give it a couple ticks possibly on that stop loss through a break of VWAP. And our target was that daily resistance level that we showed you in the chart of 313. And we exited this trade at 344 in the afternoon once it touched our target level. So looking at this trade, doing a trade analysis, let's see how it fared using these SPY calls. So the trade entry was when SPY was at 310.51. We bought the SPY call 310 strike price with a 6.5 expiration. the premium was at $2.35. So let's look at that, okay? So again, we talk about options being a contract, right? So with a call, it's a fixed price. So that fixed buy price is what price? 310. That's the spread. That's what's known as the strike price. Now the expiration, we talked about it. The expiration is when we have that right too. Well, remember we took this trade on Wednesday, 6/3. We chose the nearest term expiring options because they typically have the most volatility, and that was the 6/5 expiration. Okay, and basically we were 51 cents in the money. So if you look at that, our intrinsic value was 51 cents. So of the premium, 51 cents of the $2.35 was premium. The rest was implied volatility and time value. So it kind of gives you an example of a breakdown of a premium. Now we bought, I'm using in this example, obviously we do something a little bit different with where we're at, but in this example, I used every trade as if you had $5,000 to trade. Okay, so we bought 22 contracts. At a cost of $5,170. The trade exit when we got out at 344 was the SPY was at 313.10. Okay, so the call at the time when that SPY was at 313.10 was $3.96. And then we sold 22 contracts for a total revenue of $8,712. So let's look at a summary of this. So we bought calls for $5,170. We sold them for $8,712 for a net profit and loss of $3,000. Okay, and again, this does not include expenses and stuff like that. So ROI is 58% in that trade. Now, if we're wondering what our risk was, okay, our risk was based off the VWAP, and at the time we calculated the risk where the SPY was at the VWAP at 310.30 of $200 on those options. That's how much we would have lost on the options had we had to get out. Okay, and by the way, when you decide to take a trade, this is another important lesson. You need to not worry about, okay, how much I'm putting into the trade. Okay, how much you're putting into the trade should be based upon how much you're willing to lose on this trade. Okay, and that's most important. And most people do it the exact opposite. So we were actually willing to risk about $300 on this trade, but came in a little bit less here at a $200 stop loss. Now, if you were to, I just want to show you if we were to use the SPY and just buy the shares because we don't do options, right? How much would have you made? Well, let's take a look at that. Using that same $5,000 number, you have 16 shares you would have been able to buy for a total of $4,968. You would have sold them. Those 16 shares at $313.10 for a total of $5,000. You would have made a whopping $41 or a 0.9% ROI on a risk of $3.36. Now you may say, Mike, how is that possible? What's the difference here? Well, remember, this is why we are using options. This is why, because we talk about leverage, liquidity, right? So options, when I bought that 22 contracts, I actually control 2,200 contracts of SPY. Now, if you were to buy 2,200 shares of SPY, you would have needed a lot of money to do that, right? And that would have meant that your risk would have went up, and it would have been a lot different ROI. So this is why, to us, if you're scalping or if you're doing a short-term trade on SPY, let's do the options because they work out best. So let's go back now to the chart because I want to show you guys the chart of where we are, okay? And so you can see this on the chart again. Okay, let's look at the chart. So again, this blue line right in here, this is the pre-market high. Stock was trending above VWAP. So we purchased once it broke through that pre-market high. Right in here, if you're looking in here, you can kind of see that trade. Now, what we don't do is, we won't trade in the beginning. We kind of like to let our stocks kind of filter out. So, you have price discovery, you have imbalances that need to be corrected. So the first few minutes, we were really not trading in there. So you may see that break we didn't trade in the beginning. So, we traded this break right in here, this nice hold, and then you can see right here this ascending triangle. And so that would have been a nice spot to purchase the shares again. And then, obviously, if you're looking in here, you have SPY that, went up nice, kind of provided a nice little zipper in here, but held VWAP support and then drove even higher. And you can see how it, it touched this level to the T, came back down, actually went back through that level, tried to drive some people, and then proceeded to come back down. So, we're always putting in that number ahead of time, so we know our trades are going to get hit ahead of time. And looking down, the ADD still elevated the whole time. In this little zipper during the afternoon hours, you're going to see some drop in there. That's natural, okay? So we really weren't too concerned with that drop in the middle there. Though we were ready, some people, what they would do is take maybe 50% off, possibly in a drop in there. But if you look here, you really didn't get any extreme levels to the downside, but once in here, and it was very short-lived. So using the tick in conjunction with the ADD really helped us stay in the trade and set it up. And again, in the afternoon hours, we were vindicated because we went back to elevated and remained elevated there. And you can see we have our 22 line right here, which really helps us weed out some of this noise. It looks like a kind of a little bit of a heartbeat pattern. Okay, let's take a look at the next trade. Let's look at trade number 2. These are the charts that we have for trade number 2, and let's kind of analyze them before we actually get into the trade matrix here. So again, you have, and by the way, this Friday was when we had those really good unemployment numbers hit across the wire. That were unexpected. So, you had futures just drive up. You can see them drive right up here on the 5-minute chart, and just, they came back a little bit and touched VWAP and continued to climb up into the open. So some of you with SPY gapping up so huge on such a big number may have been confused how to trade this stock on this market. So let's take a look at this. ADD, so if you look at the 2008, the 1800 to 2000 line, this is actually higher. The ADD line is actually higher. We're actually upwards to 2400, which is extreme of the extreme, and we never break this level all the way down until the end, which we'll talk about here. And if you look at the tick opened up way into, way up. That's an outlier there, but you can see we're popped up to max up here, and, we stay extremely elevated in this level, never really coming down into this level down here in the morning hours. So this trade, nice little trade, and we have a little ascending triangle here with a support of VWAP. You can see it clearly on the 15-minute. So obviously creating this little flat top was important for us. So this set the trade up, and so we took our buy right in here, and you can see our 2 daily levels stacked on top of each other. We have a level right here and a level right here, and it went and hit our level to the T. And then we also had another trade back in here on this day when we had a little switch in metrics going on. But let's take a look at the numbers on this trade. Okay, well, if we look at trade number 2, the setup, again, this was Friday, June 5th. This is when we had those huge, so the story, we had a story, I should have had that up there for a trade setup. We had the story, which was a surprise number to the upside on the unemployment numbers. We had the ADD that was in an extreme range. We had the tick that was in an extreme range, and, stayed in that range pretty much for a pretty good time for much of the trading day. And you had SPY above and holding VWAP and the 22 EMA. And, we had a break of the pre-market highs, and we had an ascending triangle. So, we played the break on the break of the ascending triangle at 1050. We had VWAP as our stop loss. Our target was the first daily resistance level, which was 320.79, and we touched that target at 11:30. So we were in this trade. When you look at the analysis of this trade, we were in this trade for 40 minutes. So let's take a look at the trade analysis. Trade analysis. There we go. All right, trade entry. So we got in when SPY was at 318.68. We bought the SPY calls because we're looking for the stock to go up at a 319 strike price, 6.5 expiration, which means it is expiring that day. Okay, that's important to note. And the premium was 69 cents, which of course, it's in hundreds. So that would have cost us, one contract would have cost us $69. So you buy 72 contracts is what we did in order to get up to the $5,000 level. The trade exit, SPY was at 320.75 40 minutes later. The call premium went to 1.95, and we sold 72 contracts for $14,000 in total revenue. So let's look at the summary of that. We paid about $5,000 for the cost of those calls. You got to take out expenses, of course. And the proceeds was about around $14,000 for a $9,000 profit for 40 minutes worth of trading. ROI of 183%. Because we were a little bit farther away from VWAP, because we waited onto the ascending triangle break, we had a risk of $800 if the options had went the other way and touched upon VWAP. So not a bad trade. Now let's look and see if you had actually went and did the SPY shares. Well, you would have been able to buy 16 shares again, 5,098. You would have sold those shares for 5,132. You would have made a whopping $33. You would have only risked $10, and you basically would have been able to buy, after expenses, probably buy a package of gum. So you can see here, unless you're, if you're trying to buy a $300 stock or ETF here, you got to have some significant size. And even then, even if you do have the significant size, really, why would you, if you're going to do a scalp trade like this and you have defined risk, you have liquidity, and you have leverage, why would you not do the options? Okay, so that's something that's important to consider. So let's go back to the chart so we can look at that trade again so you can see where the trade looked like. Okay, back again. Let's take a look at this trade that we showed you, ascending triangle here. Break of pre-markets. If you're just curious about a break of the pre-market high, you're talking about pre-market high right in here, okay? Really probably would have got whipped around a little bit, but you would never been faked out of the trade, and we're close to that ascending triangle. So this was a really good execution from our team. You can kind of see here too, if you notice, the volume drove us up, kind of died down through here, and then this final drive up through to the point was to the target, the daily target. There was an increased volume bar. That was important. If you also notice right here, you can see we had these extreme elevations, but then after we hit that target there, you should notice the change that we start seeing in some of this composition of the tick and the internals of the ADD. So, which will now lead us to our last trade, our third and final trade that we took the same day. And it was a put trade. So we're actually looking for the stock to go down. And let me set this trade up here. You can kind of see it. So what we saw to really initiate this trade, we saw the ADD starting to fall. We saw at the same time the ADD was falling, we saw a lot more extreme levels in the tick. And let me line the tick up. Okay, so here, right in here, when ADD was falling, you notice, you see this little downtrending line here. You start seeing now some more wicks. You see this cross over the zero line. We had never even come close to crossing over the zero line in this trade here, right? Once we were in it. So you can see that the composition have changed. And here, prior to when we were in the call trade, in the trending trade, you can see constant elevation, constant staying in that level. But here, you start seeing now we're kind of like hovering back and forth, and you start seeing that change of composition coming back down here, right in this area here, which is really, preceded our trade. And plus, we also, and this is why it's important to have some of these charts up, you see a nice bearish engulfing candle on this 15-minute and also on the 5-minute, right? And you had a bearish engulfing candle here in the 5-minute, which started preceding it and actually showed us to look at that trade a little bit. And then the final piece of this information was that if you look here, we came up pierced through this daily level, and this is a really important level, came back down, pierced the level, tried to pierce the level, couldn't do it, came back down, tried to hit the level a couple more times, couldn't do it, finally had this failure into VWAP, pretty strong failure. And typically when you see a strong failure like this, and you start seeing some change in composition, and they can't make this drive through, a lot of times before they drive back down, and this is just something you really can't teach, it's something you learn by experience, they drive the market up to get out, to try to get in the hands that think that, oh, you're going to get this breakout, because I'm telling you, there's a lot of novice traders who are always looking for breakouts, and there's more breakdowns than there typically is breakouts, just so you know. And so what they do is they drive this candle up off these two candles coming down, and then this was our setup. We went short right here, and it provided to be a break of VWAP, a nice little trade in here. So let's take a look at the market numbers so you can take a look exactly what happened with this trade. All right, let's take a look at the trade numbers. So again, trade setup, ADD had declined, shifted out at extreme range as far as extreme range. Tick was under the zero line, down from an elevated extreme range. SPY had failed daily resistance several times, and we had bearish engulfing bars all over the 5-minute candle as far as the 5-minute chart was concerned, which signified a trend reversal into the close for us. So 3:30 is when we got into this trade. We got into it short. Stop loss would have been the previous 5-minute candle high, okay? And so very short stop loss. The target 318.69, which was the previous break we had last time of our ascending triangle in the morning. And when you see the chart, you'll be able to see that. And then our trade exit, we got out 348. Target was reached, plus you got something that's called trade imbalances that come out at 350 at the retail level. So you don't really want to be in a trade at that point. So we wanted to get out. We were going to be timed out of this trade no matter what before 350 because of that situation. So let's go look at the trade analysis now and see how this trade would have played for us in trading the SPY. Well, trade entry, SPY was at 319.96. We bought the put now, okay? We bought the put at the 320 strike price, 6.5 expiration, and the premium was 51 cents. So let's look at that. So if you're buying a put, before we were talking about buying a call, well, if you're buying a put now, you have locked in a sell price. So you have the right to sell a stock at a specific price. So you have a right to sell at 320, but yet the SPY is at 319, so you're in the money 4 cents. But this contract expires today. Matter of fact, it expires 30 minutes from now. So you can't get any closer to expiration, and you really don't want to hold that contract into expiration. You do not want to hold those in expiration. So 51 cents, of course, you control 100 shares, so it's 100 times that, $51. We could have bought 98 contracts at $4,998. And then we would have sold it about 18 minutes later. The SPY was at 318.63. You might say, well, Mike, that didn't really move that much, but guess what? We're on expiration day, so it gives us a huge win because, now the premium, if you look at this, the option is in the money $1.37. Okay, so before we were 4 cents in the money, now we're $1.37 in the money. So you have a lot bigger win on a smaller move like this. And this is why we like trading these options on expiration because of that. Because, the option premium will never go below intrinsic value typically. So that's something important to understand. So SPY at 319, 318.63. The premium is $1.44 for $14,000 in proceeds. So again, summary. $5,000 to buy them, got to subtract expenses. You got proceeds of about $14,000 for a net profit of $9,000, 183% ROI for an 18-minute trade, risking $350 on the options because we had a defined risk of the previous high of the 5-minute candle. And again, if you had shorted the SPY, you was shorted at 5,119, bought them back at 5,098 for whopping $21 profit and a $2.88 loss. Why you would do that, who knows? So, that's something that's important to understand. And, let's go back to that chart if we can. Okay, looking at this chart, you can see here the constant test, and failed test, drive down. You see this engulfing candle. This is where we shorted. Our stop loss was this high of this candle here. So that would have been our stop. And, you can see the trade worked out really well. And of course, we talked about getting out before that 350 time frame with the imbalances. Well, you see what happened at 350. It drove it right back up, SPY right up through VWAP. So you didn't want to be in that trade during that period of time or play that. So made a good call on that. And so that's really the synopsis. It doesn't look like much, but when you're using these charts here, you can really, and you're using your levels, and you're using everything that you've been taught, from your candlestick patterns to, the ADD, the tick, and some of the story. And plus, also part of the story, it was a Friday going into the weekend. You typically have some kind of people want to lock up profits. And especially on a employment number day, typically Friday going into the afternoon, and even the Monday after that, typically you don't see much action on employment number when the employment numbers come out. So we kind of had that story and that information in our arsenal, so we knew to look for the fade, and we got a nice little fade. And it also helped that we had we were using options that were expiring in that day 30 minutes from then. So pretty nice trade to hold. Okay, so that's the 3 trades we wanted to show you. There's plenty other trades we can do. And actually, as we were filming this, there was actually a pretty big trending day down. I'm going to do a small little video on that day and how you could have traded the markets there on extreme market down. To finish up, other factors in trading the SPY that you want to take in consideration: oil, TLT. Oil. Look, the markets. Typically they need oil to go up and to be strong to go up. Now, we've had a unique period of time, but we've also had a market that's gone up strong, and we've had oil come up from a negative basis all the way up to about $40 a share. So oil is always on my list as far as on my charts to follow when I'm following the markets. TLT relates back to bonds. Okay, typically, look, if the market's going up, typically bonds are going down. So TLT could be a big, could be a precursor to what is going to happen to the markets. And then you also want to have on your charts the market leaders. Now, you constantly hear this word rotation, and stocks are rotating in, and leaders are rotating in and out. So you want to know who are the current market leaders, because a lot of times they are going to lead you out if you're going to see some type of reversal. Okay, and then other indices, obviously you want to know what the other indices are doing, and you want to have a gauge on the VIX and the VXX, which is an ETF based off of some of the VIX. So, and then finally you have the yen. Okay, typically if the market is strong, the yen is weak. If the market is weak, then the yen is strong. So it's something, it's a relationship that you want to kind of know and have in your feather, because again, it's something that could really provide you a clue. Look, nobody knows where the markets are going to go. It's easy to look back at trades. It's easy to look back at charts and think, hey, I should have done this. I should have done that. Okay. Trading the markets is a lot like gambling. Okay. What you're doing is you're looking for tells. Okay, and so some of these other factors could be tells that could precursor to an event that's going to happen to the market. And there's been many a times that we have found that either a leader has shown us something that the markets weren't showing, or one of the indicators have shown us, or oil, or any of the other stuff. I can't tell you how many times, especially in this last period, where Apple has been a strong leader to the market, and there's been a couple times that I called out to the desk, even on Twitter, hey, Apple has turned red, and the Qs were still positive, then the Qs turned red, and the SPY was still running strong. And then that was a nice little tell for the fact that the market then proceeded to reverse and came back down. Now, you got to be careful. Sometimes it's not an exact science. Sometimes you're going to have those market leaders come back in line with the market because of market strength. But really what helps you is when you're looking at the breadth, right? Is the breadth weak? Is it just these strong, these few big companies that are driving the market? As such, Apple is one of those big companies. Well, if Apple's red and the breadth is weak, well, there's a good chance that the market is not going to, is not going to not reverse. You're going to see the Apple, reverse instead. So you got to really put some of these together and get good at it. But again, you don't need a lot of indicators. You just got to really, understand price, action, and volume, and read the market. Well, I hope you enjoyed this video. Again, we don't charge anything for what we're doing here. We're trying to help out other traders, novice traders, navigate the markets, trade the markets. Be careful and be safe.